Hey, thanks, Rich, and thanks, Dan. Always appreciate the opportunity to be here and visit with folks. Basically, on this first slide, just things I'd like to cover today are I want to address a couple of questions that we had as people registered for the webinar. I thought there's some pretty good questions, so I want to kind of address those. Then I want to share a little bit about where I'm at as far as 2025 pre-harvest wheat, corn, and soybean marketing plan progress, and really more related to that is trying to identify some technical places where maybe that would be, a futures target that would be a good price that we could maybe take some action and relate that back to what that might look like as a forward cash contract. What are we covering, what are we not? And then take a sneak peek at 2026 pre-harvest wheat. Those are the things I'd like to cover. There are slides at the back of my presentation that take a deeper dive into a few pre-harvest marketing alternatives with futures and options. Just the basics. They're not recommendations. But basically, I think it's always important that we try to expand the number of tools that we have in our toolbox. And so basically, it's just to look at what are some things that we might want to consider down the road. So with that, let's move on. One of the first questions we had in the registration was, what is the potential for low global corn carryover to boost U.S. corn prices higher if yield is 3% below trend line yields? And basically, my answer is I think there's some pretty good potential for that. And to answer that, I've got the chart here that shows, not only is world ending stocks for corn down, but world less China is also down. These are not at record levels, but they are lower. And so I think that's a very positive in thing. And I would argue that probably corn will be the driver. Can't wait to hear what Dan has to say about this, but I think corn will be the driver. And some of the positives we have are the decreasing stocks that the person asked in the question. We always have, as we go into spring, planting risk, weather risk, heat risk, things like that. And then I call it U.S. yield risk. But what I'm getting at there is, we're anticipating more corn acres, right? Maybe as much as 2 million acres more planted this year versus last year. But when you look at the map on where that is, that's also implying that that's going to be more acres in the South, which typically will have a lower yield. It also, in those areas in the Midwest, it would imply more corn on corn, which will typically have a bit of a yield drag. And I think those two things combined make it, very reasonable to think that we could see 3% below trend line. And I'm looking at USDA's trend line often of like 183, and maybe a 3% below that would be more like something in the area of 177 bushel national average yield. And I think that's very reasonable. And as that maybe comes to more fruition, I think that could be a positive. Some positive there are those. The negatives, though, are wheat, right? It looks like we are ending this year U.S. with larger stocks, right, than we had the year before prior. Grain sorghum could also be a weight in this because we probably the export market to China for grain sorghum is drying up, right? And so if we can't get the benefit of selling it to China at a higher price, typically that means it's going to have to compete more in the ethanol world and also as a feed grain, which is just that many more bushels, and that could be a pressuring thing. And also, like I say, on the wheat side, we could see more wheat actually end up in feed yards this spring or this summer. And then currently, you look at that, wheat basis for most parts of the state are weaker than normal at this time of year. I was just looking at Western Kansas, and the corn basis in Garden City is lower now than the 3-year average, the 2-year average, or the 5-year average, and also last year. So we're seeing weaker than normal basis, and I think these are all kind of weaker points. Next question was, will higher corn prices, because again, I think it's going to be the leader, support soybeans and wheat? Again, I believe corn will likely be the leader, but each commodity, especially soybeans, will also be impacted by their own supply and trade tariff war type issues, right? A lot of uncertainty right now due to where we are in trade discussions. What's going to happen and how quickly will it impact us? Will it help this year's crop, or is it going to be later down the road? World wheat is tighter, but U.S. ending stocks are up. Both U.S. and world ending stocks on soybeans are up. So, that they have different sets of fundamentals. And so corn is going to be the leader, but I think we could see situations where if prices go up, corn may go more. and the others are going to be drug up, but not as fast. And if we do see a downtrend, the other commodities may go lower more quickly. Last question was crop share landowner with corn and soybeans to market. I'll run through my slides and hopefully that'll convey my thoughts. So let's take a look at pre-harvest wheat. Start with wheat and then I'll go into corn and soybeans. Here's kind of where we are. And basically, you know, we're seeing prices trend down, although since last fall, we're really in a sideways pattern. We've got about 30% of expected production priced at an average futures price of 612. The question is now, where do we go? Now, I checked about 11 o'clock. July wheat was at 541, which means we've broken through that red line at the bottom. That is not a positive. Again, we're trending down. I was hoping that we're level. It looks like we're seeing even more weakness. But again, as we move into spring, typically we're going to see cash prices kind of trend higher into May. And so with that, you know, I'd kind of suggest that, you know, we kind of look at those areas in that 620, that 640 area. We could get that high if we could see a good rally, okay? And so that third increment, or if you haven't priced anything, an area, a futures price to target might be in that 620 area, okay? And we're looking to do that here in the next 30 days. Got a chart here. This is the Kansas seasonal index, and I've got lines there representing the 5-year, the 10-year, and the 15-year seasonal indexes. And you see that 5 years a lot sharper going up into May. Over the last 5 years, we've seen that May price really strengthen, which has been very good. So then, kind of in the back of our heads, we've got it. We always say, "Man, you know, those May prices really rise quickly," which is great, and it's something that I'm kind of counting on, that we'll see a rally here and give us another opportunity to maybe do something. This table here is those actual prices for April, May, and June. And then those other three columns, May/April, it's not divided by, it's just the May price minus the April price. And so on average, May prices on average over the last 15 years are 19 cents higher. Okay. So that's a positive. Last year it was 42 cents higher. Now, if you carry that on across, June minus April, 15 cents higher last year. On average, though, the June price versus April is 16% down. June versus May, typically on average, it's been 35 cents lower. So again, what we're trying to get here is that May run up before we start weakening under the pressure of harvest. A negative here is that in 6 of the last 15 years, prices in May fell. So again, you know, our recent history, the last 5 has looked pretty good. And you look at those numbers there, 2022, the May price was $1.61 higher than the April. So it got up there, but look at that, you know, June versus May. June was $2.34 lower. So we saw a lot of volatility. The point being, though, we should have an opportunity. We're hoping, knocking on wood, that we'll have an opportunity. And if we look at those futures, maybe 620 is that area. Called around, or I went to websites and got new crop bids from across the state, starting in the west, going across to the east: Colby, Dodge, Concordia, Haven, Topeka, and Chanute. The news is that, you know, they don't look very good, right? Basis is on average, that 6 location average was 49 cents, which is 15 cents lower than what you would expect it to be. It's not a terrible new crop bid, but it's not a very good new crop bid. But both the average forward contract bid of 502 for the 6 locations and our first 4 futures price target, right? And you know, futures would suggest maybe 620 could be an area that we could do some pricing. That would give us on average that 571. Both of those are covering direct costs. The futures target, which is, you know, 70 cents higher than where July futures are right now, would cover our direct costs with cash rent, but neither one of these are covering family living or a fixed cost of production. So, you know, our profit picture obviously does not look good for this 2025 wheat crop. So I kind of touched on that. But again, I'd be looking at that 620, and that could get us up to where maybe we'd have that 571 price, and that might be a nice opportunity. This then also then is maybe a time to kind of go forward and say, okay, if my new crop options aren't very good, should I look at storing? Okay. Well, the first thing I want to look at then is what is the carry in the futures market. So I've got the July, and I'm looking at, I did this all last Friday on the 25th. July was at 551, September was 566, March was at 609. So a little bit better price. You look at those per month carries, looks like they're a little over 7 cents. Into March, it was actually even a little bit lower than that, 6.5 cents. So maybe not too bad for an elevator, but for a farmer who's paying 6 cents in commercial storage and probably at 7% interest, you're looking at 3 cents. Commercial storage is not a thing we'd want to look at right now. Kind of plugging those numbers in there a little bit more. The thing that looks good is that our expected basis appreciation appears to be potentially very significant, right? Right now, using our new crop bids and comparing that to that March futures, we're seeing the potential, right? Because so deferred basis is way wide. We really could see basis narrow a lot. So that's a very big positive, right? Commercial storage costs on average will be roughly 61 cents to get us into that same third week of February. On-farm storage costs would be like 30 cents. And so at this point, you run the numbers, it suggests that there could be some potential for post-harvest storage. Now, the thing I want to point out here is we saw the same thing last year, right? I ran through this last year in April. It looked pretty good, but that basis narrowed prior to harvest. And by the time we got to harvest, that thing had flipped, and it really did not look like wheat was a very good crop to store. It turned out it probably wasn't. So this is something to watch. Definitely want to keep our mind looking at this, looking at these bids, watching the futures, watching the carry. But I wouldn't get myself too excited about the potential for storing wheat at this point. But at this point, it is suggesting that there's some potential. But I think that basis is going to narrow up a little bit. Moving on to corn. Again, here we are, long-term trend down, right? Going back clear into the end of 2023, we've got 3 points of contact, right? December of 2023, May of 2024, and then again here in February of 2025, we would have rallies, but we couldn't break through that downtrend line. We saw another rally here in April. We could not break through that downtrend line. We brought back down low, or we traded back down lower. At 11 a.m., we were at 451. So where we at currently, we're priced at about 30% of our crop. New crop is at 466 futures. Where might be a target? Well, again, my thought is that corn very well could be the leader. And so if we can break through that downtrend line, that would be very positive this market and maybe give us an opportunity to get back up to something closer to $5. If we could do that, that would be an excellent opportunity to price another 10 or 20%, or if you haven't done anything, maybe get something done. Really in all these commodities, we're struggling to price at a profit, right? And so, we're at that point where we need to be thinking, well, do I want to take some action and maybe cut down on my losses? And again, that's something we need to be thinking about, and we need to be looking at where our opportunities are. So again, taking some websites west to east across the state. Average 6-location average of a new crop bid was 430. That was an actual new crop basis of 26 cents under. And that's, typically if we would look at, new crop, we'd be thinking maybe on average it's zero basis. And so, or for those 6 locations. So new crop basis is a little bit weaker than what we would like to see. Both the average forward cash contract at 430, and if we could see futures get up to 5, which is about what, from today, a 50-cent rally from where we are trading now. If we could get that, both that would cover our price target. That target would cover our direct costs, cash rent, and family living using these cost estimates that I've gone through in previous workshops. And again, probably I have my least amount of confidence in these cost estimates. I think a lot of people may be a little bit higher, depending on what your pumping costs are. I know Dan was sharing some stuff here earlier about trying to get some, fertilizer could be a little bit higher than what we're using in our estimates. And so I'm a little bit concerned about that, but this is the crop that we're probably closest to maybe covering. Second thing we've got here, let's take a look at beans. Same long-term downtrend from the end of 2023 all the way today. And again, indicative of those lower, or that weaker fundamentals, back in February when we were able to get corn back up at least to that line, right? That downtrend line, we couldn't do it in soybeans. So again, a little bit weaker fundamentals there. We have 20% priced at about 1073 futures. And where would the target be? Well, if we could break through this, I guess my hope is that we could get through maybe a little bit, maybe 1080 is a good target, maybe $11 is a good target in that November futures. Again, if we kind of rotate that out and we say, well, how would that turn to a forward contract bid? At 1035 last Friday, we were looking at a 6 location average new crop bid of 954. That was 81 cents basis on average. Current basis versus 5-year average is 44, so a much weaker bid than we get. But that 954 and that first futures target, if we could get 1080 and price some, give us an average forward contract of 999 estimated. That would cover direct costs, our cash rent, and family living, given these cost estimates. Again, it's always important to know what your own costs are. Don't use ours. But this doesn't look necessarily totally unfavorable, but nothing's coming close to covering our total cost of production. Okay, so that's kind of where we are. Hopefully we've shared some potential price targets that you could use. Last thing I want to do real quickly is take a look at that July of 2026 wheat. Okay, so I'm looking out here for the wheat crop that we haven't even planted. And I'm not recommending we take any action, but I think it's always good to look at that. And again, very, very spotty action. We've been as high as 676. We're much lower than that, right? We're about 70 cents lower. I checked at 11. We were at 617. We've really broken that thing off very weak. If we look at some of the things that might be available, right? You could buy a put. You could sell futures. Selling futures that if we estimate a basis of 40 cents would give me a 581. Again, prices that aren't going to very well cover my cost of production. Also, I throw out there, to get a 650 put, right, and try to buy up a little bit, the premium just seems way too high. So I put in some option colors as things to look at. Explanations are in my later handout here that you can see. But, say buying a put and selling a call would lower that floor. But again, it's very tough to even get anything that would be a futures price at $6. And so really the pricing opportunities aren't very good right now. But I think it's always important that we start just thinking about these things and trying to look forward. So with that, I'm going to turn this thing over to Dan. Again, as always, thanks so much.
Mark, I really appreciate what you've talked about there. I want to ask you, before we just charge on the outlook, in situations where you see a weak basis, we could forward contract just the futures and have and let the basis be determined later on. And again, so you'd be unwinding a typical forward contract. As you talked with people on the Farm Bureau side, any interest in that? Because again, if there's anything that we do tend to see, it's that these early forward contract basis bids probably are, they're conservative on the part of the grain elevators. But so that I guess that'd be a question I would wonder about, given the possibility of weather challenges later here in the summer, or as our climatologists talk about it, and if we do run up on the futures, and yet if the basis is conservative, waiting to see what happens, might those futures oriented contracts be something to consider?
Yeah, I sure would think so. I really do. You do. I wouldn't want to be locking in these prices. I don't like the prices that are available right now in really any of those commodities. And so I sure would agree. The risk we run is, and again, to your point, yeah, if we see weather issues and clearly, we're always in drought and there's always that risk that we could see some problems. Rains bouncing around the state right now. We'll see how much we get. Seems like we're going to get less than we thought. So basis could strengthen. But one of the things we see often is that, if you look at basis for the crop year, typically, if it starts out weaker, it just kind of runs weaker than average the whole doggone time. And so, it could just be a weak basis begetting a continuation of weak basis. But I'm sure, like I say, world-ending stocks on some of these commodities are all down, not all of them. So yeah, things can turn very quickly, and that's
And
what we're all waiting to find is when is that going to happen?
on your wheat storage strategies, um, uh, it'd be possible if a person I don't I guess I my knee-jerk reaction is that I don't know that everybody stores commercially for wheat. However, a good chunk of them do, you know, and when you look at the wheat, pardon me, the grain stocks reports that come in, you'll see in general a pretty quick transfer of wheat out of farmers' hands into grain elevators' hands, and then over the years we've seen again commercial storage by the commercials themselves, and it has tended to be a profit center as they manage basis transportation and all of that. Uh, so, gosh, when you see these carries, which are tremendous, at least they look that way to me. For again, 6.5, 7.5 cents or more, uh, and yeah, if you have a commercial storage charge and it's 5, 6 cents per bushel, if you're paying interest on that, then yeah, you're competing against 9 cents a bushel a month. Not much there, but if on farm storage, if that's half of that, then you're maybe that's more of a break even situation. What are your thoughts on that, Mark?
I would agree on really all those points. Typically, more grain or more corn is stored on farm, as you well know, than beans and wheat. Yeah, I just run the numbers and everything, but you're absolutely right. We see a lot more of it sold in. And that's why it's so much more important to chase those new crop bids and maybe try to do things on the pre-harvest side because yes, so much of that wheat goes. And if you look at the long run averages, yeah, wheat just never pays to store. Very seldom even on farm. Very seldom. I mean, there's those years, but very seldom. And again, to your point, yeah, that the carry that we're seeing on the futures market looks good for an elevator, but again, yeah, when you start tacking in everything, it does not look so good for the farmer. And again, I'm going to guess that basis is going to narrow up to the point where it's going to even look less good.
Well, we'll have to see, and a lot will depend on what we're gonna if exports come about and how weather guides. So in the time we have, let's go forth. Thank you, Mark. Okay, let's see here. Uh, Weather issues are paramount right now. Here we're in basically the end of April, and when you look at moisture, most of the dryness that is thought to be that is around, it tends to be in our neighborhood. Again, western in parts of eastern Kansas looking pretty good, but the western two-thirds, three-quarters of the state in kind of uh, from southeast to northwest dryness. Parts of the western Corn Belt dry. For the eastern Corn Belt, not really showing major problems. Interesting to see that whole North America view. Again, this is a satellite based situation, so you see up north of the border and some important production areas up into Canada, pretty dry still in major parts of Mexico. This is the predicted soil moisture anomaly out through May the 5th. So you're taking the soil moisture conditions up at the present, and then projecting anticipated weather to come in and have an impact on soil moisture. It's interesting. We're still watching parts of the U.S. Corn Belt, Iowa, Illinois, Indiana, etc., up Nebraska, especially parts of the U.S. Major storm happening. I think that uh, what you and I should do, Mark, is invite Chip Redmond from Kansas State, our climatologist, to come in and talk about the weather risks that we're facing this year. He's tended to be almost of two minds from what I've understood in that up front, it looks like we have some moisture coming, et cetera, but a fair number of climatologists, not just Redmond, are concerned about what happens just because of the pattern we've had this year. What happens once we get into July and August of this year? Um, and so I think I'm well aware that economists and weather forecasters can be justly categorized as hand wringers in that we think of the worst possible scenario and we we obsessively go after that. Yet that is an issue. uh, it does seem to be an issue this year to be concerned about. So what when we talk about the markets right now, it's and what we'll talk about here for the next several minutes will be the current situation we have without, in essence, we're doing what the USDA does. We assume normal. We're assuming normal going forward. I know that's exactly what the USDA does. That's in their policies of what they do. But if there's anything to kind of look for, I got some charts on here and I think your charts were showing that too, Mark. In that we try to quantify the risk and uncertainty in these markets, and if it's going to hit, when's it going to hit? Well, when's it going to happen? It may not be May, but June, July, August will be the time when we weigh the risk, the markets, et cetera, and we go from there. And in terms of the world situation, you can see how our dry conditions look. And then what they have in South America, they've caught some moisture in Mato Grosso, some of these key production areas, not all wet, of course. You see those issues. You still see a variance of opinion in Europe, the Black Sea region, Russia, Ukraine. And if we have hope that U.S. wheat exports will start to move forward, it's probably based on some of what we're seeing off in these areas right here in the Black Sea region and some of the challenges that are there. Some dryness. It's affected, of course, South Africa and some of those production areas. And you'll look at some maps and see not a problem in India and China. Then you look at this map and it looks like, North China Plain, some of those areas, it doesn't look just all tremendous. So something to watch. I have not heard anybody in the markets and watching market commentary, looking at factors that move the markets, talk about dry conditions in China yet. But you look on the map and by golly, it looks like there's something there. And generally, fair amount of moisture, not anything major in Australia at this time. So let's take a look at feed grain markets. So when you look at where the markets closed on Friday, again, 478 May contract. Note that the May contract is just about just on the verge of entering the delivery period. When you look at the contract volume and open interest, it's really fallen off the May contract. So in so many words, really, we're focusing on July now, and a lot of folks have gotten out of the May contract. And then you have Dees 455 and 3/4, and that price had got down below 450, 435, 440 not too long ago. So it's still representing some uncertainty in the market. Not a lot of carry from May to July. Again, about 3 and 3/8 cents. So not much. And again, and that's almost just about to be irrelevant because of May being the lead. Fall off then into September, and then Dees coming up. And this really just indicative of the pattern we've been in of late of having our low prices. When we have good crops, our low prices have tended to come in September. In fact, they've tended to come right on September 1st. So anyway, that's something to be watchful for in the markets. You can see the type of pattern we've had here of late with having dropped down again since about March, and about the end of February, March 1st. You have the lows of about 450 having jumped up to about 498 thereabouts, trading about 485 and a half. So we're in the mode right now in the corn market to where we haven't We haven't gone completely pessimistic about price opportunities. Seems we're holding up about 480 or so. The contract, if we do start to move south, again, that this is where the technical aspects of watching markets come into play. If we start to move lower, then we'll be looking at 450. We'll be looking at 428. We'll be looking at 420 thereabouts. If we start to move higher, and again, and Mark, you were talking earlier about, well, what might seasonality give us? Well, if we would start to move higher, we'd at least stop and look at where we've been before, and that would be just over 520. So we're I guess if nothing else, from kind of a technical point of view, that gives us some criteria, some standards to look at in terms of where price movement might take us. Have been following on these webinars the futures positions, and just take note that the red bars representing managed money specs is tending to be a bit, still tending to be net positive for their positions, and that the net positions for commercial hedgers had been near record pessimistic in terms of sold, and we're measuring this in terms of bushels. So 2,000 bushels here is basically there 2,000 million bushels. There's 2 billion bushels worth of contracts at that time, and then same on the negative side. So the futures at this time net is a bit positive, but that if there were going to be major moves in this market, I think you'd see you'd see the numbers move back towards for the net long, back towards 1 billion bushels, back towards 2 billion. And all this history, it hasn't almost ever gotten above 2 billion bushels long. So stay tuned. We'll see where all that goes. And when you break out the managed money people just to see where their money's at, here in what we had of late, we did run up to over 2 billion, 2.225 billion bushels long. And that was within the last 2-3 months. And then, when prices had run up, come down off of that, have come back here a bit. And we were last fall, we got to almost record bearishness in terms of the breaking out the sell positions that managed money people had versus the long positions. Had gotten down to a bearish net 2.5 billion. Not that long after that, turned positive up to 2.2, and now are just kind of seeking direction. I would say you can kind of see where our futures are at right now, about 485. I don't want to make ill-advised statements, but we're kind of at the mode again to where we have certainly been higher than 485 on corn futures, and you can explain why that happened. Well, Ukraine-Russia war, some dry conditions, etc., happening here. Major drought, 2012. Well, tight conditions coming into 2012. Got a drought, ran way up. Then stayed high until things came off. Again, financial panic, supply demand issues, all coming in a very narrow event back in 2008. But most of the time, we haven't been much above where we're at. And so I guess if there's an admonition, I'm trying to be objective on this, we haven't historically gotten far above where we're at unless we've had some event to deliberately take us there. So Mark, as you look at pricing issues again, so we're at 485, and that right now for us is not attractive. It's not covering cost of production with the basis adjustment. However, just in terms of where it stands, we don't often get above 485, heading towards $5, unless we've got a drought or a geopolitical issue or something like that happening. Mark, any comments on that?
No, well, I just totally agree. Totally agree. And that's why I think, yeah, we if we see some opportunities, a weather scare here and there, something, that moves things up, we shouldn't allow ourselves to be afraid. to take a little bit of price action, right? That yeah, it could continue to fly up to 750 or 8, but if we get that opportunity at 5 December, we may want to consider a few bushels getting them priced.
If it's going to fly up there, then something has to happen to change the current supply demand perspective. It's you have to have a change in the structure of the market right then from where we're at right now, and that could happen. And looking at this, uh, so the I guess the seasonality of prices is kind of represented here. U.S. and Kansas corn seasonal prices. That's this purplish bar, and you can see the trend we've had. So we have actual numbers. We had a run up in February, March, now in April, and anticipate with futures showing some strength, a little bit higher than the normal mode, and through there, and then dropping off sharply into July and August in terms of where projected prices would go. So I think the futures are certainly that they're aware of these trends, that they're not trading the range of what can happen. They're trading a little bit of an inkling of what the risks might be. But so here you got this type of a pattern. It is pretty docile compared to the ups and downs that we've had over time. But you do see if we don't have one of these issues, if drought doesn't come, then the clear trend as we head out towards from June into July and August, et cetera, is for prices to move lower. So we're right in a really critically important time. Cash prices in the area, not much to yell about there, but again, still the strongest price. Garden City, 10 cents over basis, 489. We did reach over $5 here not too long ago, and we had some strength in the markets. Forward contract bids, 5 over again in the Garden City area, the strongest basis, and again a variety of these around the country. Take note though, in that here you've got the cash of the spot cash price for corn of 489 is actually higher than the spot wheat price. So we've the ratio of wheat to corn is 97%, and just pretty similar, almost that in both southeast and northwest Kansas. So probably an indicator, at least an incentive for livestock feeders to consider feeding wheat at these low prices. And hey, we're coming into harvest. So that's something to be mindful of when we start talking about where the wheat markets could go. And corn acres, I'm going to move pretty quickly now. We talked about this last week. Again, the USDA projected 94 million acres in its Ag Outlook Forum. Farmers came back, and the prospective plantings report at the end of March said 95.3. Other than the 2 years, 2012, 2013, that's be a record high corn. They're projecting, and I think the market's paying attention to the USDA's projection out of that Ag Outlook Forum of 181 bushels an acre, and that's fine. The last several years, you can take a snapshot from 2014 on. We've been pretty level in terms of where we've been at. We did jump up last year, 179.3, and that number had been about 172 or 173. That change all happened in the January final numbers. So now the projections 181, and clearly that 181 is based on long-term trend. So I'm going to I think there's certainly a chance that could happen. With any dryness, et cetera, that's probably may not be attainable. And Mark, your reasons were very good, well stated with regard to how a broadening U.S. corn production base isn't friendly towards high overall average U.S. yields. When we could certainly get those and higher in the heart of the Corn Belt, but for all these other places on the fringes, it works against it. It's going to be pretty hard this year to get below 15 billion bushels of corn. In fact, at these acres, it's going to be hard to get much below 15.2 or 15.3 if you just have a lot of corn acres. Now here's if my own thinking, if USDA's projections probably about a 30% chance of that happening. And it's more likely to be something along the lines of 179 or thereabouts, which is about been the highs of what we've had. Then you're still ending up with 15.6 billion bushels. Uh, just quickly, strongest pace of U.S. corn exports that we have had since at least back into the 2004, basically since 2012-13 drought. And you can see what that drought did down here in this low line. These are weekly pace, etc. Well, what we've got going right now is the strongest U.S. corn exports since that time. So that's generally supportive of corn prices. Almost surprising. It hasn't driven corn prices higher, but the world sees a good bargain, and the U.S. dollar is just slightly weaker than it was. Most of that, still 34% of it's going to Mexico, 18% to Japan, Colombia, about 10%. What you don't see on there, of course, is China. China had been a corn buyer in the past several years, not because of these trade contentions, not there right now, but we'll just be polite and say Mexico is a pretty important uh, colleague, trading partner with the United States right now. Ethanol production still holding up decently. You can see both the weekly stocks in the purple and up here and the production rates. So we're just about ready to head into the driving season for that would be friendly towards U.S. ethanol use, and stocks are going down. So that's friendly towards the profitability of those ethanol plants and continued future corn use. So here you go, U.S. corn stocks and stocks to use. This is again my own thought. There's 40% chance of something less than 181 bushel an acre that the USDA put out. If you with the USDA's number, you got about 2.1, 2.2 billion bushels of carry out. With something less, still just matching previous records, you're at about 1.9 billion, still quite a bit of corn, 12.7% stocks to use, leading to still relying on that ag outlook forum price projection here of 420. Take note, though, in the May WASDE report, and I think that's coming out on May the 12th, you'll see the first WASDE report projection for corn supply demand and for crop supply demand for the 25-26 marketing year. And I'd be really surprised if they didn't take the acres that they got out of the prospective plantings report, plugged in the trend line yields that they had from the Ag Outlook conference, and it's going to probably come in with a large crop, big carryover, low price projection. I think that would follow the conservative pattern that the USDA World Ag Board takes in these, and we really don't see them come off of that much, those high yields especially, unless you have a year like 2012 and it's obvious we're not going to hit trend line yields. Most of the time they don't come off of those numbers until you get out into August and largely September. So the USDA projections probably throughout the summer for corn are going to be something that if the market doesn't agree with, it has any questions, they'll have to just have a difference of opinion, because the USDA numbers are probably going to be pretty conservative all the way there until we actually get in-field surveys. So seeing this last month when we talked about where prices are likely to go, again, I think the 181 bushels an acre certainly attainable genetically. A lot working against it. Say there's about a 3 out of 10 chance of that happening, which means, in my own thinking, there's about 7 out of 10 chance of it not coming in with something less. 179 bushel an acre in this scenario B, 177 pretty decent, about 25% chance of that, and then of course the 1 out of 20 of being pretty tough. But even with the 1 out of 20 on these acres, you're still at 15.3 billion bushels. So we're just gonna have a lot of corn this year with this acreage. And what you're probably most wondering about is, well, probably what you're wondering on is that, okay, I'm sitting in on this webinar, and this guy from Kansas State is telling me that there's a 70% chance that the USDA numbers are way or that scenario is way too bearish. So then what does he really think? What do you think for prices? So then we're looking at prices closer to 460 to $5, and if we have a drought or something, 550. So instead of the 420 that's out there, something closer to 460 to $5 would be, I think right now, given the questions we have about late summer weather, et cetera, is probably more where I'm at. And Mark, so you look at that and this is a U.S. average corn price. When you look at your scenarios that you talked about and our corn and your corn pricing pricing goals, et cetera, how does this 460 and $5 tie in with that?
Yeah, good question. And I don't know what slide number it was, but if you go back to that one where we're looking at saying, hey, maybe we can get up to that 480 futures, that'd be a 450. That'd be locking in a new crop bid. That would be equivalent to a forward cash contract on average for the state of 450, 454. So, yeah, if we can get that 480, that if we can get it and price it $5, I'd be thinking that that's going to get us close to meeting your 40% chance in a 460 average price.
So with this look view of the world, we're not throwing in the towel. That in that again, it's almost May 1. There's a lot of uncertainty still to be dealt with in the markets and throughout in the next 60, 90, 120 days. And not I think it's too soon just to plan on 420 and just get completely defensive would be my thought on it.
Most definitely. Yeah.
So let's go on. So and then you see how the stocks to use figures would work out, et cetera, and for all of that. So let's move quickly. There was the question about world corn. I wanted to talk about this just a second. So world stocks to use for corn are at an 11-year low, and a 3%. We have to get our calculators out. 3% below trend line yield. The trend line's 181, so that'd be 178. Let's see, 178. So you're looking at, right, you're straddling these two, 179 or 177. And so you're looking at something about arguably 250 to 350 million bushels less. You convert that out, and that would have an impact on world production to some degree and tighten up these ending stocks more. That the only caveat right now is that the world is so myopic. It's so much in hand in terms of not worry about things because hey, why worry? Anybody that's worried in the past has always been wrong. We'll just wait till we absolutely are forced to drive prices higher. So what that does, it brings more of a docile response to anything. But then when they're forced, then it's panic. So anyway, we're not sitting in a situation in the world corn market where we have lots and lots of extra corn. In fact, the world stocks have generally been trending down. That's the whole world. Let's see, that's right. That's the whole world. And if you look at world minus China, things are even tighter. We're the tightest for corn, 9.3%. That's the April 10th projection since at least 2007. So a 3% lower trend line yield, 250 million to 500 million bushel lower, say in the U.S. Production would impact the world situation. It's just a matter of how quickly and how aware the world market is of that situation. Okay, well, let's move on. I've got a number of other slides here. In terms of what was sent to you, sent you the whole deck, and so you can look at things that you would wonder about Brazil and their supplies for corn, Argentina, Ukraine, Russia. Note the downtrends in both of those for corn. We look at grain sorghum. Generally, grain sorghum. It was interesting that USDA projected, well, we'll get about 6 million acres planted of sorghum. Farmers came back in end of March and said, you know what? I think we're going to plant about 6.6. Some dryness, et cetera, all in play in terms of how many grain sorghum acres are planted in Kansas, Texas, Oklahoma, and nearby areas. Grain sorghum just struggling on exports. Here in the last week or so, just a little bit of life showing up, but that is U.S.-China trade conflict for us in agriculture in Kansas. Evidence evidence part A that this trade row between the United States and China certainly affects things and mainly affects grain sorghum. You can see when these discussions happened, we didn't have that bad of a year going on, but suddenly we basically went horizontal, and and we can shift over to using again, when grain sorghum is not being exported, it's a competitive feed grain. It's based on value for feed usage, for ethanol usage, et cetera. So we'll see where that goes. Okay, we've got a few minutes. I'm going to move really quickly here with the idea that corn's the main leader and a lot of other things will follow. So let's move quick. For soybeans, you can see not much carry in that, just kind of a sideways market. Again, you've got South America coming on, and some of these August, September prices reflecting that. Just not much going on there. 1035 harvest contract, 1059 July. Not much in terms of that differential, but soybeans with the discussion that, hey, China and the U.S. are now talking to each other more, that maybe it's not all forlorn, that when you look at the three major futures complexes that we're following, we follow a lot here at K-State, corn, hard red winter wheat, and soybeans. By far, soybeans have been the strongest here of late. You can see still in the last week or so, you can see this bit of net positive now for the soybean market. It's not much, but hey, when down market, you'll take anything you can get. So it looks, at least it's net positive, and you can see some of the movements, a bit of run up of late in terms of managed money futures. The long components of their positions generally trading out some with the bearish one. So not much happening yet, but a little bit of positive in that market. 1059 quarter, same comments we had with regard to where we're at in the market and where, when we've been much higher, what took us there. Were things that were extraordinary, again, out of the ordinary. It wasn't just normal production. It was short production scenarios, strong export demand. Right now, we've got headwinds in terms of this trade issue with China in particular until it's dealt with. So about 1059 in terms of where we're at, it just objectively looking at it, what I think we asked the question, what will take us sharply higher? A drought would, and that could happen, but probably not right now, not just tremendous trade movement. Projection 1001 off the futures as we calculate it, and that's just, again, same as what the USDA is projecting. Note the variability in the soybean market. Again, soybeans tend to come in later. June, July, still holding it pretty well. August, a little bit later. Well, we answer the question later on in the summer, about a month later, as to whether we've got a great crop for soybeans or not. And you can see that in this June by the time we get to July, August in Kansas, we tend to see prices go down in a normal year. In the majority of years, that starts to happen more in August for soybeans, and that's just a physiological growing season issue. Cash prices, note we are above $10 cash wise in the Topeka area and the Hutchinson area, so nothing to write home about here. Mark, just I guess a lot of variability basis wise, and I think your numbers showed that too. But 90 under, 90 to $1.05 under out in the West, 50, 54 to 55 to 60 under at about every place else. So kind of is as it is. Acres down a little bit, 84 million acres. So for the same reasons, that's going to be hard to get below 15.2 in terms of crop size this year. With the cutback in acres, it's going to be hard at anything but stellar yields to not see soybean ending stocks tighten up. Probably, well, here's this projection 52.5. Again, in previous records 51.9, 51.7, but long-term trend line yield projection, that's fine. You've got with these acres at the USDA number 4.28 billion bushels, would just say still strong usage for bioenergy for crush, basically. Spottiness in terms of soybean exports. And here's a soybean export pace, just about middle of the road, nothing great. Still, even with what has been bought, still been China is still the leader in that. Soybean stocks with the USDA's projection, which I think there's about a 1 in 4 chance of getting because of the high yield figures and what's out in front of us. 287 million bushels. Ending stock 6.5%, and that's with strong yields, about $10. And then there's this. So it looks more to me like ending stocks. If there's a 1 in 4 chance of the USDA actually getting of the U.S. having 52.5 bushels per acre, and then 75% chance of a lot less than that. And the bulk of this is coming somewhere around 51 to 49.5, about 70% chance. And instead of 287 million bushels, 6.45% stocks to use, you're more like you're plus or minus 25 million bushels, around 200 million, 4 to 6%, and prices 11.50 to 13.25. So, Mark, here's where you don't have to ride side saddle with me and agree with everything that I say. That's for sure. But in terms of the goals you have for the soybean plans, 11.50 to 13.20, where does that put you in terms of pricing opportunities?
We were looking at a target, a place to start would be 1080. And given where, again, as you touched on it, we're seeing very variable basis across, but, I kind of have my quote 6 location average. It was 81 cents under. A 1080 would give you a 9.99 basically forward contract price or a cash price, adjusting here for basis and what we're looking at. So I love that 11.50. That's good. I'll take that. That's $12 futures. That's fantastic.
So here we got a back and forth that's happened in the ag sector. So farmers made good economic decision and said, it looks like back we saw what we were doing heading into March 1st. We think we're going to plant more corn acres. So we decided to plant more corn acres. And now when we look at what's happened, if we carry through on that, it looks like we've swung the price potential back away from corn back to soybeans in the fall by the time we get there, just because of large acreage of corn, tighter acreages, lesser so of soybeans, and different situation. I don't know if anybody's going to change what acres they're planting for between corn and soybeans because of this type of thinking, but it's an action reaction situation in the market. So thought provoking. Let's move on. So you can see where prices might go. In essence, it's probably an eat your hat moment for Dan O'Brien come this fall. Say there's a lot higher chances soybeans having better prices than not because of the acreage issue. So we'll see where that goes. And world supply demand for soybeans, large South American crops. The large crop this year is in the red. What's in the blue is the anticipation. Well, pardon me, I'm wrong on that. This is 24-25 marketing year. The blue is the large crop that that's come out of Brazil largely and parts of South America. And you can see big impact on world index stocks and stocks to use. Not much differential between world stocks, world minus China. They don't have a lot of stocks that they carry. And you can see that this large crop up here in Brazil having a big impact on what's projected for this marketing year. Pretty good crop down in Argentina, etc. So we've got just a few minutes. Let me hit wheat quickly. There's where the Friday closes in the wheat market. There are the carrying charges that we've been talking about, and I guess in a nutshell, if you're going with commercial storage, that's already eaten up 6 cents of that, and then have any other interest charges on that, that's, unless you're going to ignore the interest, you're self-financed. It's in commercial storage for farmers, probably that may not be there. Maybe with on-farm storage, that's a possibility. Mark, what we probably need to look at though, with that carry, at the next time we get together, is to see okay, if this endures, then what can we look at for buying for at least to look at the direct comparison between the cash cost of storage versus the cash cost of buying a call option, and to see how that would work out one with another. And by the time we get a month from now, if the market turns so pessimistic, then the price of those call options might, some of the time value might be out of them. So we can put that on our notebook to look at for next time. And trading in a range, in fact, heading out the bottom end of that range here of late as harvest approaches 551. Looking at the July contract, anticipating large harvests. And take note, the RSI. I've watched the relative strength index that's heading towards. This is about 25. It's about 70 thereabouts, and heading towards the low end of any momentum in that market. Just is as it is with harvest approaching. Net position for hard red winter wheat turns bearish. The latest number in terms of the net, 240 million bushels hard red winter wheat net to the sell side. And for managed money traders, again, kind of a tepid, anemic, little bit of long, mainly bearish sell positions for managed money spec people. Just is as it is. And so we're down at about 550 and 3/4. We're about 551 and had a low of 527. So we're bouncing along the lows. In fact, if anything right now, it's probably a risk that coming into harvest, if we keep receding, do we break below the 527? And so for ag producers who have commodities to sell, that's the only thing that could be good out of that, is generally we're taking commodities and we're looking at cost of production, trying to match cost of production. If we were just trading movement, by the time the market goes down and in more of a spec mode, then I think they call that selective hedging. But we're really not selective hedgers. We don't talk about that here so much, but that's probably what if we do get a big low in the market, that's probably where some of the spec traders will probably go. 520 projection in the futures, 550 by USDA. So again, a differential turned pretty pessimistic in the wheat. Cash prices, again, 518 tops in Salina, Topeka, Hutchinson, 473s, 463, other parts of the state. And just kind of quickly, this is more for your own reference. U.S. wheat planted acres, you can see the trends, hard red, recent uptrend, but generally still predominant acreage wise. But you can see the production we're looking at here by class. So U.S. hard red winter wheat still strong as a representative class of wheat, but having a hard time right now moving the product. And you see weak trends for exports overall. U.S. wheat exports, hard red export trends at about the lower, in essence tied with the second slowest year that we've had of late. And export buyers, who buys from us? Mexico, Philippines, South Korea. Strong food use, weakness in exports, and we'll see if we can meet the 820 to 850 goal for that next marketing year. 820 for this. Again, pretty stocks to use about 550 is a price, and then note, and that equals the reference price on some of our farm program payment situations. All of this, and it's kind of the promise and the question of how such tight stocks in the world can lead us to this situation, and for other sellers in a with different currencies, less distance, they're taking advantage of opportunities to sell wheat, whereas we are buyer of last resort, supplier of last resort. We have a 10-year low stocks to use for wheat, and overall world situation still lowest and tightest we've been since 2007, 2008, and still trending downwards. Sometime out there's a collision between tightness of world supplies and a year when the world market's backed into the corner, doesn't know where to go, can't get other wheat, with a drought or something like that, and then the wheat prices start to shoot higher. But until then, we're going hand to mouth and just hanging on. It's a pretty, in my view, it's a very speculative situation right now, and that it's the underlying fundamentals increase the likelihood of having pretty strong wheat prices out there sometime, but until it happens, until you change the mindset of the wheat market, just not much going on. Well, hey, let's stop sharing. Thanks for staying with us, folks. I appreciate that. And I would say, Mark, the more I hear your production, your discussion of this, I'm thinking, hey, we should go with more of that, because you're really touching on the main issues there that need to be talked on, and I just hope to supplement some of what you're talking about. So,
Dan, you got a couple of things in the chat there.
Okay. All right, let's get this on down here. Question from Bree Bats. What do you think the impacts will be of a nationwide E15 this summer? Announcement came out this morning. Thank you. I had not seen that. Well, that's sure an interesting deal. We just saw the latest inventory numbers, and they're not going to the higher side. In fact, they're tightening up. And if anything, actually, the stocks numbers and there's at least temporary weakness in the production. So that's a demand pull, and I hope I'm seeing this right, but by legislative mandate, by the Renewable Fuel Standard, 9-10% of fuels are required. What's sold for motor fuel goes into that, and then if it goes to E15 during the summer, then you've just upped corn demand. So that's a positive on the usage side, I would say, and would lend strength to would lend strength to the corn market. That by itself gives underlying support. That, along with any worry about size of the crop, then you're starting to move, and you bring volatility to the market.
Hey,
Bree, I
Dan,
saw your hand waving. Is that getting at kind of what you're thinking?
I got a quick question about that. The fact that, right now corn futures are down after the announcement, is there a bit of a argument to say that, well, maybe part of that, the nationwide was already built in. And so as a reaction, we're not seeing anything in the futures, and maybe it would have been one of those things where if they would have said we're not doing it, we would have seen, prices fall. I don't know. Do you think part of that was built in? And there's some expectations because it's not bouncing futures right now.
Well, we'll see. I think the expectation might have been there. What's odd to me is that again, we could go back and look at that chart. The quantity will have will. I don't know nationwide that we've been selling. We've have some E15 going on, but it's mainly E10. You know, normal. So if we open that up and people buy it, then it's stepped up corn usage and stepped up demand. Now, Mark, you're probably right on, and I'm missing the boat, and we'll come back and discuss that next time we get together. But just A plus B equals C. It looks like to me I don't see how we can avoid having that not increase corn usage to feed the ethanol plants.
You bet. But I
So
think the announcement was just for the summer.
it's just for the summer.
So it's a part, so it doesn't mean we're going to go from 10, maybe 10.1 or 2%, because I think we're a little bit above 10, but yeah, you're right. You got that blend wall of at 10%. I don't think it's going to mean we're going to flip it up to 15 yet. We would need to have year round,
To have it in,
ethanol availability,
to have
and
an
we'd have to have all the retailers selling it.
to have an enduring impact, but in the short run, it seemed to be positive and supportive at least.
And then there's one other question from Ward Taylor. Did you see that? Did our seasonal rally
Did our
in
seasonal
December
rally
corn?
in December corn happen a couple of weeks ago, or do we still have a shot in May? I got Ward. I spend time quasi ridiculing the myopic nature of traders, and now I'm going to come back and say, well, you know what? It's I think that the underlying factors that would cause risk are still out there to be dealt with. If anything, being a little bit dry has helped planting. So I don't I think that the seasonal rally is I think it looks at what's right in front of it, and what's right in front of it will be either weather problems or not. So I guess I think not. I think we still have a lot of risk and uncertainty, and you can see it historically from May into June, and if problems are persisting off into July. So Ward, I would say with strong conviction, a 60% chance that no, it hasn't all happened yet, which is a pretty cowardly way. But I say it, but there's still a lot of uncertainty to be dealt with, and I just but the market looks at what it has right in front of it, and right now it's not seeing the problem yet. That doesn't mean that typically we don't have that problem. So.
Well, I'm not seeing anything else, so I think we'll call it a day here. We'll have another one of these towards the end of May, but I'm not sure we have a date set on that, but I'll be sending out word when we do have that ready to go. So thanks for being on today. And Dan and Mark, thank you for presenting all this and discussing it.
Thank you, Rich. Thanks, Mark. Appreciate your work.
Thanks, everybody.